Knowing how to close an option is easily one of the most important things to know about trading, since it's pretty hard to make a profit if you don't know how to sell. Let's talk about it. Hi y'all, my name is Greg and I make videos about the stock market and options trading. Today, we're going to be talking about how to close any type of option, whether it's a covered call, a regular put, a spread, and everything in between. I'm going to have the timestamps down below so you can just skip ahead to whatever type of option that you need to close. But before we get into it, if you like this sort of video and you want me to make more option tutorials like this, make sure to let me know by leaving a like down below and subscribe if you're new to the channel. With that out of the way, let's talk about closing. The first and probably the easiest type of option to close is going to be your regular calls and regular puts. Since you're going long on these options and you're buying them, in order to close out of them, all you have to do is the opposite and sell out of these. And this should come pretty intuitively if you've been trading stocks for a while, since most of the time whenever you're trading stocks, you're buying and selling out. There's a handful of reasons why you might want to close out of your options. Maybe you've already made a ton of profit, or maybe you're at a major loss, or maybe the expiration date is coming up and you don't want to hold your options into expiration. Generally, I wouldn't recommend holding options into expiration because you're evaporating all the time value that's left in it. And in general, it's never best practice to exercise your options. I'm going to make an entire video on why you should almost never exercise options or hold them into expiration. And if you guys want to see that, make sure to leave a like down below to let me know that's what you want to see. But anyway, getting back to our regular calls and regular puts, in order to close out of these, all you have to do is sell out. But with short options, it's going to be the exact opposite. Since you sold a short option like a covered call or a cash secure put to open, in order to close out of these, you have to buy to close. I know this can be sort of a weird concept since it doesn't really come natively, since we don't usually short stocks. That's usually left for the hedgies. But to close out of your short options, whether it's a covered call or a cash secure put, all you have to do is buy them back. This is going to be a common theme that you'll see throughout this entire video. Since you shorted this option to open it, all you have to do to close it is the opposite and buy it back. The way this works is when you sold your option to open, you created an entirely new contract, which is why you might hear this called writing option contracts. And since you're the one that's setting up the terms and conditions for this option contract, you're basically the creator for this option. And whenever you want to buy them back in order to close your option, you're either going to buy them back from somebody else that's writing a new option, or you're going to be buying it back from somebody that's selling the option to you that they originally bought. Whenever you buy an option back, you're going to have to pay a debit in order to close it, since you were first paid a credit in order to open it. And if that debit is worth less than the credit that you initially received, then congratulations, you just made a profit. But if it's more, then you'll actually be at a loss for your option. Generally, it's never best practice to buy your short options back at a loss, since you're the one that set up that option contract and you should stick by the rules that you set up. If you agreed to sell 100 shares of a stock at $10, but now it's trading at $15 after a huge rally, you should be okay with selling it at $10 since that's what you originally signed up for. There is a case where you would want to buy your option contract back, and that's when you reach 50% profit or more, since you've realized most of the profit available in that trade. And at that point, it's usually best practice to take profits then than waiting until that expiration date. That way you can free up your capital and use it on another trade. The next type of option that's going to be a little bit tricky to close is going to be spread, since this is kind of a combination between our long options and our short options combined, since in order to open a spread, you have to buy one option and sell another. In order to close out of these options, you'll just have to do the opposite of how you open them. And to take you through a little easy example, we're going to use stock XYZ. Let's say we entered a call debit spread on XYZ with a $100 strike price and a $99 strike price. In this case, to open these options, we would have bought the $99 strike price and sold the $100 price call. This means we're long on the $99 strike, short on the $100 strike, and to close out of this, we'll have to perform the exact opposite. So in this case, we would sell the $99 strike that we originally bought to open, and we would buy back the $100 strike price that we originally sold to open. Here we're regular selling to close the $99 strike price and buying to close the $100 strike price. If this was a call credit spread, this would be the exact opposite, since we would have originally sold to open the $99 strike price and bought to open the $100 strike price. So to close out of this, we would buy back the $99 strike price and then sell out of the $100 strike price. This can be applied across any type of spread, whether it's a credit spread, a debit spread, a calendar spread, a box spread, and everything in between. I would always suggest closing out of spread options before their expiration date, because assignment and exercising can get a little bit messy. Sometimes your brokerage will assign you on your short options without exercising your long options, meaning that you might be on the hook to buy or sell 100 shares of a stock that you don't own or that you don't have the cash for. If you had something like an Amazon put credit spread and the short option expired in the money, but the long option didn't expire in the money, then you would be on the hook to buy 100 shares of Amazon, which will cost you $300,000. Definitely not a situation that you want to get yourself stuck in. So generally best practice to close out of your spreads before they expire. Iron Condors kind of work in the same way as spreads, but instead of buying one option and selling another option, you're actually buying two options and selling two other options. And to close out of them, you're going to have to buy out of the options that you sold and then sell out of the options that you bought. I know it can be a little bit confusing, but again, just do the exact opposite of how you open these options. Let's say I opened an Iron Condor on XYZ, selling a 105 call and buying a 106 call, and then selling a 95 put and buying a 94 put. We would do the opposite to close, meaning that we would buy back the 105 call and the 95 put, and then we would sell the 106 call and sell the 94 put that we originally bought. In this case, we would have received a credit in order to open this, and in order to close out of it, we would be paying a debit. If that debit is worth more than the credit that we originally received, then we'll be at a loss. But if that debit is less than what we originally received in credit, then we're going to be at a profit. Again, just like credit spreads or short options, you want to buy these options back at a cheaper price than you originally sold them for. And finally, the last type of option that I want to cover is strangles. And for strangles, you actually have two types. You have a long strangle and you have a short strangle. Whenever you go long on a strangle, you're buying one call, one put. In order to sell out of this, you're going to have to sell out of your call and sell out of your put. With a short strangle, you'll have opened it by selling a call and selling a put. So to close out of these, you would have to buy them back to close, and you want to buy these options back less than what you originally sold them for. So in order to close out of any type of option, all you have to do is the exact opposite of how you opened it. If you want to know the next options that I buy or sell, I post all my trades over my premium Discord, which you can find in my Patreon, link down in the pinned comment below. Thanks for making it all the way to the end of this video, and thank you to all my patrons for the support. I really appreciate it. And as always, remember to stay positive, stay green. I'll catch you on the next one. Bye, guys.